So continuing my equity story, I spoke about Sun Pharma. I mean, there are other examples like EID Parry, Oracle Financial, where all my valuation didn't help because the share price just didn't move up; it moved down. Then it stayed parallel to the x-axis. It went nowhere near the y-axis, right? In the sense, it never went up. So yes, I have made mistakes. But why am I telling you all this? Why is simply because once you have a process, you will make mistakes, in the sense that, but you will build yourself a strong solid portfolio because you followed a process. Not having a process means more based on luck rather than based on a process. So what is my process? My process is, it's a rigorous process, and I wait for my entry price, right? So if I think a share is worth buying at 40 and the current price is 45, I will not succumb to it even at 42, unless it's a great share where, or it's a very low market cap. Let's say it's got only 300-400 crores market cap, then you can't wait so strictly, because 5% is hardly, it might 40 rupee share can go to 42 in half a minute, right? So then it's a different thing. But if it's a big share, like say an LMW or something, I'll never be able to get it at the price at which I want. I just keep buying because I know, okay, I can add more without any worry. Ashai Glass is one such company. I keep adding because I can never wait for the perfect valuation. But value discipline is very useful in the process, saying, okay, this is the share which I want to buy at 45 and 45 only. So then when it comes to something like 50, you put it on your radar and say, oh, this is not too bad. Let me buy it at 46, 47, because I don't see the price, the market going down. So if I think the market is going to be very strong, then I don't mind overpaying a little bit. But again, a little bit. I will not buy the same share at 70 rupees. At 70, I would be a seller, right? So this is the way you accumulate share. And for me, if I have, say, bought 5,000 shares of any company, I will trade with 500 shares, and I will trade maybe 5-6 times in a year, maybe sometimes even more. That keeps on reducing my holding cost. That's again in the mind, but I keep saying, okay, I've invested so much, but I've recovered so much money by trading. So that happens, and dramatic, like shares like EID Parry, Coromandel International, Cholamandalam Finance. I have traded Tata Motors DVR. I've traded in them so many times that my original cost is perhaps negative, right? That is how trading profits help, and I don't mind paying a little extra. For example, if I buy Ashai Glass today at 600 and odd, right, say 610 or 615, hoping to sell it off at 715, this is my trading position, and the price actually goes down to 550 or 530, I actually can go and buy more because I bought only 10%. So let's say I've got 5,000 shares, I've sold 500 shares, and then the price goes up. I don't mind holding a position of 4,500. Similarly, if I've sold at say 700, or if I've sold at say 630, then I find the price at 550, I don't mind selling another 500 shares, right? Because again, that is adding up to only 1,000 shares. That is only 25% of my total of what I'm holding, right? So then I don't mind, I can buy it back. So therefore the discipline helps, saying this is the price, this is the pivot around which I will play. If it goes above this, I'll sell. If it goes below this, I'll buy. And if I've sold and the price actually goes up, I'm more convinced that I can sell more rather than buy more, right? So I do some of those things. I really wait for my entry price before I put my money. So this gets me the discipline. It also believes that if I slip in any one area of disciplined investing, then I will slip very badly totally. So the purpose of not overpaying for security for any share that I buy is simply because I want to improve my probability of not losing. See, I keep saying this, not losing for me is very important. I'm a very conservative, darpoke kind of an investor. I take aggressive trading positions simply because I know that there is a equity backup, right? So therefore this discipline helps, because you will never be always right, and I have a very simple rule: I have to be more right than wrong. And the question is, when I'm right, how much money did I put in? So if I was right in say CARE, This is a share which I bought at various prices, and my average price should now be around 480 or 460 to 480, and the price is about 550. The average price is lower simply because I bought very aggressively at lower prices, because I thought once the economy turns around, it will do well. And it has done well. So this discipline of saying I will buy only at a particular price, of course you get carried away when you meet an analyst or you meet an investor, or you even worse meet the management, you get carried away. But you have to, if you have this discipline saying okay, I get a decent dividend yield, I know I'll get some appreciation in the end. There's a 4% dividend yield, and if there is a 5% appreciation year on year for 2-3 years, I can't lose too much money, right? I'll get 8-9%, which is what which is better than what I can anyway get in the GSEC or something like that. So therefore the discipline helps, and if the asset is good at a particular point in time with the dividend yield, then it can't be too, I mean, you're less worried about the downside. So that is how it helps, and it helps in improving the return, and it gives you a bigger and bigger moat. And if I bought a share at say 45 rupees, knowing I'm going to get 4 rupees dividend, that is a 10% dividend yield. Even if I get 2-3 rupees as dividend, and which means there is earning fall, yes, the price will fall, the dividend will also fall, but the dividend fall may not be too high. And after 3 months, 6 months, 8 months, when the industry turns around, the same share will turn around. Those are the advantages. The downside to having the discipline is to say, okay, in this industry I want to take an exposure because it's a good industry to be in, and this is the dividend yield, and this is what it will do. And the thing is, I never go to zero position. For example, right now I do think that pharma is doing well. It will do well for some more time. I am convinced that banking will do well. So therefore my banking positions and pharma positions I am not willing to reduce. But money has to come from somewhere, right? There is no machine. I have no income other than largely my dividend income and trading profits. So I take that and I say, okay, I need to sell my, let's say I have to sell my IT because I think my pharma and banking will do better than my IT. That may be right, that may be wrong, but the thing is, I will never go to zero IT. I will never get out of HCL Tech, Wipro, Infosys, whatever be the price, because TCS, of course, sorry, the father of them all. And I would be in large IT, I would be in small IT, right? I'm not naming the small IT for obvious reasons. So in the large IT, I may go down from my position of 100 to my position of 30 or 40, but I will never go to zero, simply because I know that I could go wrong with pharma and banking, and that is when IT does well, I would be too distraught to know that, oh, I had zero position. So that is one reason, and that's another reason why I invest in mutual funds. They're much better balanced than what I would ever be. I will get carried away, I know that. So the fact that I invest in mutual funds also means I look at their portfolios and see, oh, this is what they're buying and this is what they're selling. Of course I can do that without investing, but when you have stakes, then you on that fund manager, then you look at it far better and far closely. So those are 2-3 things. Even with all boxes checked and everything, sometimes you go wrong. Sometimes when it does not look too great, you still make a lot of money, right? So you could some of these things could happen, right? Ashai India Glass, when I bought it at 140 or 160, 170, I knew it would go to 300 because that was my valuation matrix. So I was not willing to pay 250 for it because I thought, oh, 200 is a good price, maximum mein 300 jayega kind of stuff. It went to 300 and then I revised my opinion, and now it's at 600 and I again revised my opinion. So you can see some of those things. Sun Pharma, for example, when I bought, I thought maybe 900 is a good price to exit. Then I saw the price, I said, okay, 1100 is a good price to exit. Now I'm still greedy. At 1100 I may sell off a little bit and still hold on, right? So all those things will happen on your way, but still having the process is important. Why am I making this video? Because there have been requests for more equity videos, and I'm convinced that I can add some value there. Secondly, there are times when you look at a share and you say, okay, I will buy this share, but I will be very, very sensitive to any price change because it's very closely held. To me, Avenue Supermart and Patanjali are in the same category. It's very easy to buy them and go completely wrong because somebody close to the management is selling. For example, Avenue Supermart is not there in F&O, it is not there in any of the indices. Patanjali is on trade to trade. So is there a reason why Patanjali is going up? Maybe it's trade to trade, so nobody can go short. So it's a very high risk share, because sometimes you may not be able to sell because 80% is held by 1%. Similarly, there are stocks like Vent India, which is a which is a grinding wheel manufacturing. I own Carborundum Universal, Isab, Ador, Vent, and Grindwell Norton. So this confusion. And I would always look at electrodes and grinding wheel together. So Vent, again, very low floating stocks, and you don't know what to do, right? So you buy, you sell, you cannot get these shares at the valuation at which you want. There is just not in LMW, Bosch, you will never be able to get them at valuations that you want. So you keep a list and say, okay, when these share prices come down, I will buy. That's all. There is no great logic to saying, okay, I will buy it at this price. I will buy LMW only at 14,000. Well, if it's available at 16,000, you have a choice of whether to buy or exit that counter, because that counter will not come. It requires tremendous patience, the patience of an alligator, for the price to come down. So you put it on your list, and then when somebody like China gives you COVID, you go and buy it. It sounds very opportunistic, but yes, that is only such reasons why these kind of share prices go down. I can't imagine Asahi India being available at 150 any time in the recent future, unless it company goes for 1:10 kind of a split, right? But COVID gave us that opportunity. Prism Cement, another share, was available at 30 rupees for a share which I was willing to pay, hold your breath, 100 rupees, right? So it was available. So I bought at 70, I bought at 60, and then 30 was like, this is loot, right? So that is why, because if you don't have a list of what to buy, what shares to buy, the whole thing goes down. So for people who don't know what to buy when the market goes down, best is to invest in the index, or sit with a bunch of shares saying, okay, these are the shares that I will buy when I get it at this price. When I get it, suppose I value a share at 100 rupees and I think it's a great buy at 100. And I have not bought, right? That's very important. If I bought and I'm already holding a position at 75, I would get out. So 75 would be my lower limit, unless I'm very, very convinced that it is a great buy, but I would not be. That is why I would not have stayed on in shares like, assuming even I bought Google, Facebook, etc. somewhere mid-journey. It is not as though I would have entered at $10, right? I'm not an employee or whatever. I wouldn't have entered at the bottom price. So I entered here, and then the market fell. I would be out, simply because I had my discipline of saying 25% fall is what I can take. So I know I never kill myself thinking, oh my God, if I had bought Google at this price, if I had bought Facebook, I just would not have been able to hold on to it. I have bought Zomato at high price in the sense about 105 or 107. Then I sold, then I bought, then I sold, then I bought at 130, then I bought, and then it fell. Then I sold off at 120. Then I was waiting for Damodaran's valuation. So when it came down to Damodaran's valuation, I bought more. So right now I'm in the money in Zomato, but I've told myself I will not sell Zomato under stress. So let's say the price is now I think 70 or whatever, 70, 75, whatever, or less than that. But if it falls to 30, I'm still a buyer. I'm not a seller, because I believe that the share is worth buying at a particular price. So if it falls below that, I will buy. And I've completely given up my rules for something like Zomato, because I know when the market sentiment is bad, some quarterly results are bad, or something like that happens, or Swiggy does not get enough valuation, something like that happens, then suddenly the price would go up or it would go down dramatically. I've told myself I will look at it for 10 years. So somewhere you tweak and change the rules, but otherwise if you tweak and change the rules every investment that you make, you can go wrong. So that is the thing about discipline. You have to be disciplined every day. You can't be disciplined every Friday. Thank you.